compared to South Africa, with loans to GDP of about 90%, financial intermediation to the real economy is still constrained. What are the challenges?
The major challenge had always been, and I use the word hard because we've dealt with the problem. When you can walk into a bank today as Bisi or Onasanya with the same face, and tomorrow I walk into another bank and I'm Modele Sharafa Yusuf, it simply means that I cannot be tracked because of identity problems. And in the societies where you have had increased financing of consumer products, because essentially that's what drives the market, you will see that they have dealt with the issue of their national identities. And you cannot owe a bank and move on to the next bank to borrow money and escape or vanish into the system. So it was a major impediment. That's very important. Now, that has been dealt with. But beyond that, you also need to look at the financial ability of both the individual and the businesses being funded to repay your loan. The mere fact that I have that liquidity to lend out does not necessarily mean I will throw caution into the winds and begin to give out loans. So beyond the issue of addressing identity issues, we also need to be sure that the enabling environment allows businesses to prosper in such a manner that they are viable and that can repay their loans. So oftentimes, even when the money is there, if I assess the package, the application, and I realize that the underlying business cannot be viable enough to repay the facility, I will not approve the loan. So banks are in business not to lose money. It's not social security. It's a business to which we have responsibilities to many stakeholders, including the shareholders of the institution. Unfortunately, we have found in the environments where, because of high cost of infrastructures, the cost of operating businesses in some environments are so high that when you subject them to the true test of financial viability and analysis, a lot of them cannot meet repayment obligations. And that explains why it's difficult to say loan growth has not been as fast as it should be. But I think we need to deal with the fundamental underlying problems of businesses being able to be run efficiently in a manner in which they can repay their loans.
You know, some say part of the problem is that there are too many big banks like yours, and they tend to lend to large corporations and invest in government securities rather than lend to the SMEs, for example. They really don't have time for the SMEs, which is where the real economic growth happens and where jobs are created.
Again, Modele, I don't agree with you, and I think we should all refrain from generalizing things. The fact that some banks don't lend to SMEs does not mean that First Bank does not lend to SMEs.
Talking
generally, okay.
About First Bank.
Okay. Now, I will speak about First Bank, but I also do know that First Bank is unique because we don't have too many banks who take the approach to business that we take. Most banks see things purely from what's the financial benefit in it to me. We see things from, we like the financial rewards, but we also think that we need to strike a balance between our developmental roles and our profit objectives. That's sustainability at the end of it all. I would say that for certain reasons that I had mentioned before, it's not all SMEs that are viable. We need to understand that. And unfortunately, we've also seen that a lot of them, when you subject them to the viability test, the credit appraisal process, some of them are not qualified to take the loan because if they take, they will not be able to repay. What we have done in First Bank is to partner with a number of institutions, including the NASME, that's the National Association of Small and Medium Scale Enterprises, in which, as a group, they approach us. We fund them as a group and ensure that they do all the necessary reviews before, almost like what I call a shortlist, before the projects come to us. We do have a dedicated unit within the bank responsible for SME financing under our retail banking structure. In addition to that, we also have specialists in agriculture. We actually have a separate department for agriculture, which is one segment of the SME. And we have what I call the commercial banking business unit of the bank, which is the middle segment of the market. This is in recognition of the fact that we admit that the risk profile of people in the SME segment is not the same as the risk profile of companies and individuals in the corporate segment of the market. They are a lot riskier. They don't have structured management. They probably don't have audited accounts and so on. But that does not mean that they don't need funding. So what we've done in the institution is to make sure that all the risk areas that we have identified, we have built structures in place to make sure that there are mitigants to those risks rather than running away from those risks.
You know, that's one part of the problem. Affordable consumer credit is yet another. You once served on the Presidential Committee on Reduction of Interest Rates. Why have interest rates remained so high?
Interest rate is a function of the environment in which you operate. We need to understand that. You also cannot take interest rates in isolation of the various other indices in the market. What's inflation rate today? Inflation rate is projected to hit the double digits in the third quarter of the year. You understand that? So if the cost of funds to me is high, and people should not look at the direct cost of funds, which is the interest rate to pay on deposit. Today, banks pay as high as 12 to 14% on fixed deposits. Government instruments, treasury bills and bonds, are technically referred to as gilt-edged instrument, that's a risk-free instrument. But today, the pricing is in the neighborhood of 12 to 14%. That's the benchmark. Unfortunately, when you take the cost of funds into consideration, that's the direct cost of funds, and the indirect cost of funds, which is the cost of running your branch network from which you generate those deposits, and you put all those costs together, the cost of funds is not low, and it's not small. And then you're expected to make a margin to take care of your general overheads and returns to stakeholders, tax authorities, your workforce, and of course, your shareholders. So I will not imagine that we should take the issue of interest rate out of context without looking at the overall environment. When interest rates are high, that's the cost of getting the deposits to fund the loans are high. You cannot expect that the loans will be at low rates. Now, what do we need to do? We need to also understand that we have a government that is also obsessed with defending the exchange rates. Now, the way you can defend exchange rates also includes tightening. Tightening means taking liquidity out of the system. The liquidity you take out of the system becomes unavailable to fund growth in terms of granting loans. As we speak today, First Bank has at least about 650 billion naira of customer deposits that are sterilized in central bank as cash reserve requirements at 0% interest. These funds are not at zero cost to the bank. So when you tighten and take liquidity out of the system, and yet you are expected to meet the minimum liquidity ratio of 30%, what that does for you is that a large chunk of your deposits are not available to lending. We need to understand that. And I need to put on the table that your 30% minimum liquidity ratio requirement by central bank is expected to be invested in assets that are termed liquid by central bank, government instruments, cash or near cash instruments. So when you need to comply, and it's mandatory that you comply with all of this. When you need to comply with all of this, what is left for you as an institution in relation to the size of your deposit portfolio becomes reduced. And you therefore tend to recover the overall cost of those deposits from the few things that you can lend to the market. That also affects how banks can lend generally to the system. And we've got to deal with that.
Time to take another break. Please join us again after the break.